Ever put money into a savings account that earns a little bit of interest, but wished it could do more? Stablecoins can also earn higher yield on lending markets and exchanges. But once they're there, you can't really use that money anymore. So you end up choosing between yield or actually being able to use your money. That's where Resupply Finance comes in. What Resupply actually does and why it exists. Because today, crypto makes some sense. Let's take a look at how it works. You start with stablecoins like CRVUSD or FRXUSD. These are the stablecoins used on two decentralized lending platforms, Curb's LlamaLend and Frax's FraxLend. You bring those stablecoins to Resupply. Resupply then deposits them for you into a lending market of your choice on LlamaLend or FraxLend, where they earn yield over time. Here's where it gets interesting. Resupply then lets you borrow its own stablecoin, ReUSD. And this part is important, so listen up. When you deposit CRVUSD or FRXUSD, your collateral earns lending yield on the underlying market. When you borrow ReUSD, that introduces a borrowing cost, which pulls your yields down. Resupply is designed to offset that cost using its own native token, RSUP, distributing it as incentives directly to borrowers. When you combine all three, most of the time, the position actually continues earning yield even while you're borrowing. Resupply also has an insurance pool, a reserve that helps handle risk inside the protocol. If positions become risky, it helps absorb pressure and avoid sudden liquidations. So instead of choosing between earning yield or using your money, Resupply is built to let you do both. If you found this useful, check out Resupply at resupply.fi. And if you want to make sense of other crypto topics too, follow us and like the video.